Rob, a lot of movies we haven't seen before, and no one's seen this movie with the pandemic. But in terms of what happens with oil, maybe we've seen similar things when prices get so low, it disincents production, and then it kind of self-corrects. In a lot of that zero, and when we were actually paying, people were paying for delivery or paying to not take delivery. I mean, that was a technical factor, right? But for whatever reason, the market has corrected itself.
Yeah, so I think that's a pretty fair characterization. In one sense, the free market works. And so the risk to going through, sort of the tank tops, if you will, from a storage standpoint, sent price signals that in turn, right, created an outcome where a lot of supply got shut in relatively quickly. A lot of that happened in late April and really very early May here. And so I think what we've done, Joe, and as you referenced, a modest rebound in demand, right, coupled with a lot of shut-in production has effectively rebalanced the market, thereby avoiding the outcome of going through tank tops in full storage. So in one sense, right, I mean, nothing cures low prices like low prices. Mr. Market worked.
But you also said slight rebound in demand. And what we got on the price move, if you say, supply is part of it, but a lot of this, we're hanging our hopes on this somehow forecasting demand rising. Is that psychological at this point? We're assuming it's going to happen. Have we really seen demand pick up at all to get a move from $10 all the way back to 25 or wherever we are today?
Yeah, so I mean, we have seen, and it depends. The data varies pretty dramatically across different markets. But in some markets, call it, here in Texas, but also up through the Midwest and places like the Southeast and markets like, Jacksonville, Florida, Atlanta, et cetera, you've seen a recovery in demand, especially on the gasoline side of, call it up 50% off of the lows here from back in April. In some of the harder hit regions, New York, the West Coast, you haven't seen as much of a recovery. But I think what's really happened here is the refining industry cut utilization rates. Refinery runs down to a level that basically matched the true trough in things like gasoline demand 3 or 4 weeks ago. And so as demand has started to recover, and again, right, modestly from a total lower 48 standpoint. Right. But as that started to happen, you started to see gasoline inventories draw, right, which in turn is putting a floor under demand and prices.
Yeah. Hey, Santoro, we're interested in oil, but we're not the oil channel. We're really more of a business news and stock market channel. So it's really how it affects the equities markets. You were part of our conversation on May 1st, sell in May. I don't know. It started that way. Now I don't know where we are again. I don't know what to think. Things look like we may be reopening some parts of the country. The market seems much more stable, just in general, as the VIX comes down. We had Mike Wilson on yesterday saying his base case year-end target is 3,000 for the S&P. Yeah. His bullish target, 3,250. Are we really back to where we were just last October before we even heard of this horrific virus?
We're back there with index levels. We're not back there remotely with economic activity. I think there's a few things happening. One is the focus on just incremental moves in a positive direction off a very low base. That applies to what crude oil prices are doing. By the way, a month ago it was at 30. A week before it went below zero, it was at 20 oil. So it's not as if, we're in some zone now where it's at all clear. It's just way up, because positioning is much cleaner in the futures and everything else off of a very low base. So the market's definitely keying on this idea of incremental progress towards something remotely like normal. But the effect of the big dominant stocks in this market, you can't underestimate them. And I mentioned yesterday, a fifth of the S&P 500 is down 40% off its high. It's really the big stocks that seem to be kind of holding things together for now. But in a bigger sense, you have a lot of stimulus. If there's this growing sense that what the Fed's doing and what Treasury has done and what Congress has done might actually provide a bridge to something more normal, then, of course, you have this high liquidity, return to growth type story. It's all on the come, though. I mean, it's not something you're seeing really in the numbers except for, like I said, incremental improvement off of a super low base.
So back to oil, Rob. We near the high end of the range for what this economy globally is good for at this point, you think?
Yeah, I think in the near term, that's probably right. I mean, I think we're sort of stuck in a range of, call it, high teens, low 20s on the low end, and somewhere, up here in sort of the mid to high 20s for the near term. We've got a lot of crude in inventory and a lot of finished product, things like gasoline as well. And so we're going to have to work through a lot of that, right, over time here before prices can really go materially higher, right, back to something that's close to what I would characterize as the marginal cost of supply, which is substantially higher than where we are today. But we've got, a lot of, call it, wood to chop, right, to get there.
The level that where we are right now, does it take just the worst case scenario for all the leveraged producers? Does it take bankruptcy off the table, or at least it makes it a little less likely, doesn't it?
Well, for some, but Joe, I would say unfortunately not for many. And so while prices are up off of the lows, I think the short answer is $25 oil doesn't really work for anybody, and anybody's defined as whether your name's Saudi, Russia, U.S. shale guy, kind of go around the world, right? These numbers just don't work. And so there's going to continue to be a lot of pressure, I think, in the market. And I would just caution that some of what we see on the screen here, call it $25, is not what is being realized by certain producers. So in the Bakken Shale in North Dakota, an example, right, prices are still close to zero on a fully realized basis. And so that's going to continue to keep a lot of pressure on some of the more levered and call it smaller, right, those producers that just don't have the scale and size to survive in this environment.